Hello and welcome to Winslow Capital's second quarter 2019 large cap growth strategy review. I'm Barry Peters, Managing Director of Winslow Capital's client service team. The second quarter of the year was a solid quarter in both absolute and relative terms. 9 of 10 sectors within the Russell 1000 Growth Index delivered positive results in the quarter, with energy down 3% being the sole negative performer. Our portfolio performed well on an absolute basis, modestly outperforming the benchmark. Stock selection in the healthcare, industrials, and information technology sectors drove our positive relative performance for the period. Moderately detracting from performance in the quarter was our stock selection within the consumer discretionary and communication services sectors. On a year-to-date basis, our performance was exceptionally strong in both absolute and relative terms. Our return outpaced the Russell 1000 Growth Index, the S&P 500 Index, and also ranked well ahead of our average large cap growth peer. All 10 sectors of the Russell 1000 Growth Index gained ground in the first half of the year, led by information technology, while the healthcare sector lagged the most. Stock selection in the healthcare and industrial sectors contributed most to our strong relative performance. Stock selection in healthcare was particularly notable given the sector was the weakest performer in the index, underscoring the need for strong microeconomic analysis. Continued avoidance of the consumer staples sector was also additive to relative performance. Modestly detracting from relative performance was both the weighting and stock selection in the communications services sector. Looking at our investment roadmap, last year's fourth quarter decline in global equity markets was driven by slowing global growth and fears that policy errors would further undermine the fragile global economy. The mirror image of these factors facilitated the rebound in the first half of 2019, with the Federal Reserve shifting its stance away from further tightening, followed by central banks in Europe and China providing additional monetary stimulus to their own economies. Global monetary policy is now poised to enhance growth for the remainder of 2019, and we currently see little evidence of a U.S. recession. We also see little evidence of meaningfully rising inflation and anticipate interest rates will remain low. The level of disruption in virtually every industry has widened the range of outcomes for companies. This environment creates an outsized alpha opportunity for fundamentally focused active managers like Winslow Capital. From a valuation perspective, equity market valuations for value, blend, and growth stocks are now modestly above their long-term averages. Thus, we anticipate that the primary driver for future returns will be earnings and cash flow growth. As the fourth industrial revolution drives unprecedented change, we expect that secular factors within each sector and the idiosyncratic characteristics of each holding will drive stock prices. Across the three largest sectors of the portfolio, we see key industry dynamics driving that performance. Within information technology, which is the largest absolute sector by weight at 37%, key drivers include a strong IT spending outlook driven by high corporate profitability and new technologies. Digital marketing companies continue to take share from their more traditional competitors. Electronic payments continue to displace cash and checks, and wireless data usage and the impact of the cloud are both up dramatically. Within healthcare, which is the second largest sector by absolute weight at 17% and our largest relative overweight versus the Russell 1000 Growth Index, key drivers include the fact that the cost to insure someone in the U.S. is now in excess of $9,000 per person per year. As a result, insurers are gaining members from Medicare and Medicaid, and cost containment efforts are driving an increased use of data analytics. A strong wave of innovation in med tech, life sciences, and animal health have propelled those industries, and we've seen the rise of consumerism across the entire sector. In the consumer discretionary sector, which is the third largest absolute sector weight at 17%, consumer spending has benefited from strong employment, wage growth, and tax reform. The shift to online shopping continues unabated, with online purchases still just 10% of total sales. Pricing transparency has increased, and consumer reviews have replaced traditional branding, largely at the expense of legacy consumer staples companies. Structurally disadvantaged sectors also represent opportunity for active managers in avoiding weaker business models. Consumer staples has seen the death of branding via online price discovery and user reviews. Brick and mortar retailers have seen lower traffic and consumer preferences for experiences transform their markets. Linear media continues to be under pressure in a new world of cord cutters, and legacy telecommunications is seeing no unit growth, with key competitors swapping market share largely based on pricing alone. Within oil and natural gas, producers are seeing any increase in price being met by an immediate increase in production, and REITs continue to face bond surrogate headwinds in today's interest rate environment. As the overall rate of global growth has slowed over the past 20+ years, the percentage of public companies that have delivered more than 10% revenue growth has declined as well. As with all things, scarcity drives and supports higher valuations. This simple relationship is demonstrated by the fact that gold is worth more than copper, diamonds are worth more than coal, and Rembrandts and Picassos are worth more than the artwork hanging on your refrigerator at home. Since our investment team's inception 20+ years ago, Winslow Capital has a strong record of alpha generation. But it's worth taking a closer look at the different environments in which this long-term record was built upon. The years preceding the great financial crisis and the global QE era, that of April of '99 through December of 2011, was an environment of flattish to downward PEs following the dot-com bubble. It was a period of robust alpha generation. The global QE era, December of 2011 through December of 2016, was a period marked by strong PE expansion headwinds. This rising tide of market multiples essentially lifted all boats equally, largely irrespective of their underlying fundamentals. It was also a period of abnormally high correlation of returns across equity markets, resulting in a much diminished opportunity set for active managers. The dominance of the yield trade, driven by 5,000-year lows and interest rates, skewed the market's pricing mechanism, particularly in 2016. Active managers generated their worst results in history. As a reminder, 93% of active large-cap growth managers underperformed the index in calendar year 2016, and Winslow Capital was similarly challenged. However, as painful as it was, this period set the stage for the new equity regime that we believe began in January of 2017. This final post-global QE period is in many ways similar to the pre-global QE era. We believe it will likely be a flattish to downward PE environment. It's been marked by a return to fundamentals from a pricing perspective. And finally, it's been a period of robust alpha generation. Winslow Capital's annualized alpha generation during this period has been very strong. We firmly believe that this post-global QE era will in many ways be similar to our longer-term since inception results. While we model more modest absolute returns for equity as a whole, we also model a return to more robust alpha generation from active management. Both the second quarter and the first half of this year was yet another strong period for equity markets, supported by accommodative monetary policy. However, global growth is slowing and geopolitical tensions continue. Despite years of strong performance, we believe the growth equity cycle can continue given the backdrop of this slower global growth, supported by a healthy global consumer. Thank you for joining us for today's update. We look forward to visiting with you again next quarter.